Hello and welcome to the Options Millionaire community. I'm Andrew and today I'm going to teach you my system. I guarantee it's the simplest, most repeatable system you've ever seen. Simple is the key word there. I'm sure if you spend a lot of time around the internet, you've seen a lot of overcomplicated jargon. Model this and model that, and my system has all these parts, and your furu sucks and blah blah blah. And in reality, the more complicated a system is, the worse it is. Trading is not that complicated. It's difficult, but it's not that complicated. You buy low, you sell high. The problem is, we don't know where to buy the lows at. We don't know where to sell the highs at. This system is going to help you do exactly that. Now, I call this system the 3 criteria setup. And what are the 3 criteria? The first one is volume. More specifically, a high volume inflow as price action is climbing into a supply or falling into a demand. Now, a high volume inflow or lack thereof can confirm one or two things. 1, a impending reversal, or 2, a continuation through a price zone. The second criteria is a wick on the price action. For example, if price action is falling into a demand, I am going to expect to see a strong bottom wick to show that buyers are present. Conversely, if I'm looking for a rejection off of supply, I'm looking for a top wick after a uptrend into the resistance to show that sellers are present. Now, using these wicks tied into the volume give me a great deal of confidence to what the price action is trying to do. The third criteria is going to be a close. This means a close on whatever particular time frame you are looking to analyze over the prior high close of a candle on a bounce or the prior low close on the candle if you're looking for a rejection back down. There is a fourth caveat to these rules. Now, I don't necessarily call this one a criteria because it's more of a situational awareness aspect, but the fourth rule is called location, meaning the closer you are to a very historical high volume support or resistance, the more likely the price action is to react to that level and thus give you more confidence in a trade. Now, I know this is one big word salad to you, so the best thing to do is just get into some examples. All right, to kick things off, we're going to get started here. This is the S&P chart, July 16th, and I want to show you a beautiful example of the 3 criteria on the 240-minute chart or the 4-hour chart. And we've been in consolidation for a while. Price action goes much lower here into a prior support. And the beautiful thing about this example is that it hits all 3 criteria plus the 4th caveat of location. And the price action aggressively, you see this candle aggressively moves down into the 6240 range, which is the consolidation back from early July. And then, of course, the big pivot from July 7th. So as I tell my members, is that when a price action retreats down into these levels like this, where there's a high volume of prior support, I can 100% guarantee the price action will bounce off these targets. However, I don't know how long they'll bounce, and I don't know for how far they'll bounce. So that's the hard part of trading. Of course, it's easy to figure out where they're going to bounce. It's harder to identify how they're going to manage the actual bounce themselves. So the price action does retrace into this area. It puts on a bounce. And now on the 4-hour chart, we have the first criteria of a volume inflow. So you see this volume inflow is down here at the bottom. We have the second criteria of a wick. So this strong bottom wick right here to show that the buyers have in fact stepped in. And then we have the third criteria of a close over a prior high, which in this case, that is the higher close there. The price action takes it out. And then of course, the price action moves up for another 100 points or so, a couple of 100 points in the long run. The fourth caveat of location is fulfilled by the fact of this block right here and then all this consolidation. This shows that we have a very large order book built right here of support. So understanding the concepts of volume support can identify where the market wants to induce liquidity flow. The market seeks out liquidity, and right now all the liquidity was hanging out at 6240 and all the boxes were checked. Now, if you're more interested in a deeper topic of accumulation and distribution or general Wyckoff theory that I focus on, given the principles of volume price analysis, what this would determine here is a kickoff of a longer-term uptrend here because we have a higher volume bottom wick, which would indicate what's called a buying climax. A buying climax is where the price action thrusts lower aggressively and is culminated by a very aggressive buy zone. So the price action dips lower to induce short selling, to get the longs out of the book, to basically make the book inefficient, and then the buyers absolutely clobber the candle, and then now it's time to go higher. These are how imbalances or inefficiencies are created. We hear the term imbalance around the internet all the time. These are how the imbalances are created. The order book cannot skew or trend without an imbalanced book, which means more buyers or sellers or more sellers than buyers. In this case, obviously there are more buyers than sellers. And that's how they do it. They thrust the price lower, they hammer it back up, and off we go. Perfect example of the 3 criteria plus the location. Let's take a look at a shorter time frame. All right, Here is August 1st, 2025. And there was a couple of different reasons why I wanted to show this example next. One, to show that you can exploit these levels on the 5-minute chart, and two is that these historical levels continue to work over and over again. And this is one of the highlights of my system, and one of the highlights of the teachings that I post in the Discord server is that if the average retail trader can just wait for these high-level pivots, the obvious high-volume historical pivots, you can drastically increase the R&R on your trades and drastically reduce the amount of trades that you're actually taking, which is a huge upside for the average trader. So you see that this is the same exact red block that we were looking at on July 16th, the 62.40 range. The price action aggressively sells the past couple of days. We tap this level, and then the three criteria are induced. We have the first criteria, high volume. We have the second criteria, buyer's bottom wick. The third criteria takes out the higher high right here. The prior close and the price action comes along here, and you can get yourself 20 to 30 points on this move, depending on where you actually enter. Now, a couple of notes here. The three criteria are just guidelines for confidence. The more criteria that you want to trade on, the higher the confidence of the trade is. That doesn't necessarily mean you have to wait for all three criteria to close. There are many occasions where I actually take a trade on only the first two criteria and just use the third criteria after I'm already in to confirm the trade. However, that really is dependent on location. This area here, the 62.40, that's a very aggressive historical pivot with volume. I'm more likely to take a trade only waiting for volume and maybe a bottom wick forming rather than waiting for the third criteria. If we're at a level that's not necessarily an obvious historical pivot, then I will wait for the third criteria because that is going to give me the highest degree of confidence. So the price action pulls along here, beautiful move up, and then it fails back over and uses the price action once again. Now I will say, when you have a level like this, a level that's been used 3, 4, 5 times by the buyers to bounce, is that my confidence in the level begins to diminish after about the second time. So when the price action retreats down the third time, the fourth time, the fifth time, what's occurring is absorption at these levels. So all the demand for the buyers that's sitting in this area, the sell side offerings, will begin to diminish every time the price action touches it. Because theoretically, every time the sellers retrace down into these areas, the demand is getting weaker and weaker and weaker until eventually it bounces. And the price action will kind of look like this. You'll see the price action fall, aggressive bounce, fall, aggressive bounce. And then a couple of times, maybe 3, 4, 5 times, the price action will kind of stick and fluctuate. And then eventually it'll absorb and blip, it'll come down. So after, these times here, I'm gonna play them. But after 3, 4, 5th time, I'm going to be a little more hesitant. And that's where I'm going to rely on the order flow, which I use the software of Bookmap to identify when the absorption is actually occurring for the breach. All right, here's a great example from NASDAQ on July 24th, 2025. And once again on the 5-minute chart, and you see the same processes apply. We have the move lower, and the price action right now is beginning to it's still new for the day. So people are still trying to figure out what's going on here. It's 10 o'clock-ish Eastern time. The market's only been open for half an hour. We have this move down, and then right here at this 10:10 candle, 9:10 Central time, we have a move lower with an aggressive amount of volume. Now, one of the reasons I wanted to bring this example up here is because there's not an obvious sweeping bottom wick. There are some bottom wicks, but this is more like just an extended doji. However, we do have volume with a very small, obviously, part of that doji here. The main theme about the wick is the whole representation of the price action, and we do have a strong bullish candle, which to me is a bottom wick bullish environment. So with the volume, that's the criteria number 1 checked. We have a strong green move, criteria number 2, and then we have the movement over the prior high, which is right here. Price action climbs along here, and you're able to capture about 60 to 100 points here on NASDAQ, depending on how long you hold, which is a fantastic trade. Something also worth noting is that out of all of the criteria, the most important one for me is volume, because volume is the one thing that dealers cannot hide from you. Yes, I know there are dark pool orders, but in the big scheme of things, volume is very, very difficult for them to hide. But if you notice that every time the market pivots, we have an inflow of volume. Here's an inflow right at the top. Here's an inflow at the bottom. Here's an inflow at the bottom. So it's very, very prudent for you as a trader to understand not only where the volume is occurring at on the charts using price action, but what's occurring there. And it's the reason why we have a volume spike is because the opposing party is participating to counter the order flow, aka selling after a buy trend or buying after a sell trend. So when I'm watching a trend unfold if I start to see a high amount of volume inflow on the order book, that to me is going to scream we have either hit a support or we've hit a resistance, and it's time for me to recalibrate my thesis. Okay, here's a trade from July 16th, and this is on gold. Gold has been, well, no pun intended, a gold mine the past month of July, even the whole year, because gold is very clean. One of the benefits of gold, among other names, is that trading NASDAQ and the S&P are manipulated by the very large individual names, NVIDIA, Meta, etc. Gold is just gold. And yes, it is changed by macroeconomics and whatnot, but it's a lot more pure price action, and sometimes it can be a lot cleaner to trade. So looking at gold here, we have this move lower into this red block of 33.85, which was what my plotted support was. It was support because we have a prior session low right here from the prior session of July 15th. Now, a single session low like this, like the day before, is an important level, but it's not a massive, massive support. So this is not like a monthly low or a quarterly low. It's just a prior session low. Still very important, but it's not something I'm really going to be hammering the table over. But I will look to play the position. So the price action comes down into this area, and right here at 10:30, we have an inflow of volume. Now, the definition for me of high volume is just high relative to what we've been experiencing. And forget about this right now, this big block of high orders. Look at what's happened prior. So for the entire morning, we've had low volume, and then all of a sudden we have this outlier volume that's way higher than anything we've already experienced. That to me fits the definition of an inflow of volume. We have a bottom wick, which is the second criteria, and then we have the price action begin to claim over the prior high, which was right here. There's your entry point, the market climbs, and then we blast higher a very large amount, of course supported with volume. So me knowing this, and kind of what I've already said, is that when we hit these levels, I can guarantee the market is going to react to them. I just don't know for how far, and I don't know how long. It could be just a little bitty bottom wick and then fall lower. It could be a massive explosion. There's no way for us to really know, and that's not really my intent. My intent is not to guess what the market's doing. It's to play the probabilities. So when I play these positions, what I like to do is set an entry, let it fill, place my trailing stops accordingly, and then as the market begins to climb and break structure, in this case 33.90, I will move my stop loss from a stop loss position into a profit position and see what happens. And then as the market claims prior structure, I'll shift my stop loss even higher and just to lock in more and more profit as the market breaks in structure. Now, a little side note, I don't set my stop losses based on profit. I could care less how much profit I'm making in the trade because I believe in process over profits. So as the market climbs and breaks structure, I will move my stop loss up and up and up and up even more and follow the market condition. Now, another general rule of thumb here is with my trading is that 8 times out of 10, 7 times out of 10, my stop loss will trigger, although profitable, way sooner than I intended to, way sooner than I wanted to. And that's okay because I know that 2 times out of 10, I'm going to catch 300 or 400 points on NASDAQ or even more, or 100 or 200 points on the S&P. And that's really all you need to be successful in trading is that you need a whole bunch of slow and steady small wins, small losses, and then eventually you have a big win. 2, 3, 4 big wins a quarter, and that alone will make your quarter. Okay, I'm going to end things with this example of the Dow. 2 different examples, actually. One of continuation, one of reversal. So up until this point, you've seen only examples of reversals, playing the bounces, playing the rejections. And that may make you think that I am a counter trend trader, but that's not necessarily the case. So looking at volume or the lack thereof can really indicate the process of rejections and or continuation. And this is a case where I used the lack of volume to tell me that there's absorption into a continuation setup here on the Dow. So back on June 24th, I posted this screenshot inside the Discord to say that the Dow is absorbing and there's a breakout imminent to the level of 45,000, which is this red block. This block has been posted now for about 3 months. And the reason why I came up with that, if you look at the June 24th time frame, which is right in this block here. Now this is the 4-hour chart, but if you look back, you see we have a top here, we have a top here for a double top, and then we have a third position coming up into this around June 24th. And as we come into this target for the third time, my eyes immediately go down to the volume. If we have another volume spike, like if this candle comes up here with volume, that tells me we have hit supply and we're going to have yet another rejection. However, in this case, when price action comes into it, we do not have volume. This high volume candle happened here. If you look into this price action, these are the candles I'm looking at. We have no high volume spike at all. So that tells me we have absorption by the buyers and we have no more remaining supply sitting in this area. So that tells me That's absorption. We have a lack of volume, and now we have an imminent breakout. So I posted the screenshot in the Discord. I targeted 45,000, and the price action broke out nicely to 45,000 over the coming weeks. Now, in this case, that's only one of the criteria, just volume, but it just goes to show you how powerful volume can actually be. Now, go further along here, and let's fast forward until the end of July. I posted this screenshot here about the Dow being on watch. Because we are in this level, we have now 4 rejections. 1, 2, 3, 4th, and maybe even a 5th here if you're looking at it. But more importantly is that as we come into this area, we have yet another spike in volume here to show that when we hit this target, we have a volume flow. It just tells me we have now put on supply on the books, which means now the Dow is on watch for a retracement, also in the same 45,000 area. So we wait for confirmation, we get the little top wick back over here, and once we start taking out prior lows, which in this case is going to be a lot of dealer's choice, I would like to see this low taken out of the prior low candles to show that, because that right now is the weekly structure of the market. Once we take out that, I'll be looking for a move lower. And of course, once we did take out this area of the prior low closes on the 4-hour chart, the market begins to sell off. And I know that's a great level, because we break through it, and then after we broke through it, we come back up and retest it here. So when you have a support level and price action climbs down and bounces, when it clears, I like to look for a retest of that inventory here, and then that will sell back off. So that is a beautiful flip of support into a new resistance, which shows seller strength, which happens here, and then down we go. All kicked off by the inflow of volume. So I hope you understand really how I use this volume stuff, but before we wrap it up, I want to leave you with a couple of ideas and considerations about using this strategy. So for one, in terms of location, the bigger the historical pivot, the more confidence I am going to give to a bounce or a rejection. So if we're coming up, let's say, on a multi-month low, I'm more likely to play a blind long or some sort of aggressive long off that area than as opposed to like a 15-minute bottom or a prior session low. So the longer the historical pivot, the more volume, the more confidence I'm going to give to that level, and the more likely I'm going to take a trade based on the first two criteria. Secondly is that for the average retail trader, waiting and doing nothing is a superpower. Doing nothing when nothing should be done is a huge part of being successful in trading. So waiting and identifying these historical pivots will not only reduce the amount of trades that you're taking, especially the frivolous trades, but it'll highly increase the quality and R&R of your trades, which is a huge principle of being profitable. Thirdly, this system requires you, it demands that you put in chart work, which means waking up in the morning, zooming out to the daily, the weekly, the monthly charts, the 4-hour charts, anything more than shorter time frames, and just looking to where the major pivots are. Are we coming up on a weekly low? Are we coming up on a monthly high? What this also enables you to do is fish for positions on multiple names. So you can go to the Dow, you can go to ES, NASDAQ, oil, gold, even hog futures if you want. You can pick any futures name or any individual name if you want and plot these levels and only trade when one of these triggers on any of the names. Number 4, which I think is very, very important, is that you have to tailor your short-term theses to the long-term macro trend. So, for example, this whole time we've been climbing up here, and a very aggressive, one of the most aggressive trends in history is that because the market has been so bullish on the macro, that has affected how I trade on these shorter time frames. So I've been in the theory of buy every dip. I don't really even care about the red candles. I'm not trying to short the moves lower. I'm trying to wait for those shorts to end and then buy the dip every single time. And that's because the macro theme is very, very bullish. Now, when the market begins to downturn and we have aggressive selling, I will change my thought process on the scalping side to sell the rips. Every time the market bounces, I'll sell them back over until we have yet another high volume inflow with a bottom wick to show me that we are back inside the bullish trend. So fitting the macro thesis to your short-term trades will drastically improve your hit rate and how you view the market. And lastly, if you are trading on the 5-minute chart for scalping, I always disregard the opening candle volume, which is these candles right here, because that candle is always high volume. Every time the market opens, the volume dumps in, and we always have a high volume spike. So it's very difficult to analyze. So I rarely, if ever, take trades in the first 15 minutes simply because that is pure momentum of the market. Sometimes you can make a killer amount of money, but it's not always the case, and there's a little bit more of a gamble there, which I don't like to do. I like to wait for the momentum to shift, and then I play at these high value areas. So that's my system in a nutshell. I'm very much a heavy VPA style trader. All of my decisions are based on volume tied in with how the price action reacts. If you have any questions, hit me up in the Discord. Options Millionaire Discord link is down in the description of the video, or you can email me optionsmillionaire2020@gmail.com. Come or follow me on Twitter, on Reddit, on YouTube. Like and subscribe this video, and of course leave a comment down in the section if you have any questions. Thanks for watching.